Most Canadians will never save $20,000. I'm Nathan, and I don't say that to be harsh. I say it because the data backs it up. Canada's household savings rate just dropped to 4.4% in the fourth quarter of 2025, down from 5.2% the quarter before. Wages grew only 3.1% last year, while grocery bills kept climbing. A family of four is projected to spend $17,571 on food in 2026, about 27% higher than 5 years ago. Canadians are stretched thin. Stats Canada reports that Canadians now have $1.76 in debt for every $1 of disposable income, and credit card debt is at a 17-year high. The numbers don't lie. Lower-income Canadian households save just $852 per year, while the highest earners save over $41,000. So if you're watching this and you haven't hit $20,000 yet, you're not behind, you're normal. But here's what nobody tells you. Once you actually cross that $20,000 line, something shifts. Not just in your bank account, in your brain, in the way you make decisions, in the speed at which your money starts to grow. Today, I'm going to break down exactly why that happens and how you can use it to change your financial life. Let's start with what's really going on before you reach $20,000. You're operating in survival mode. Every dollar that comes in has a job before it even lands. Rent, groceries, hydro, car insurance, maybe a credit card minimum. You're constantly doing mental math, shuffling money between accounts, wondering if you can afford the thing you need, not even the thing you want. That's not just stressful. It physically changes the way your brain works. Research in behavioral economics shows that financial scarcity reduces your cognitive bandwidth. You make worse decisions, not because you're less intelligent, but because your mind is overloaded with short-term problems. You can't think long-term when you're drowning in this week's bills. And that's the trap, because the people who need long-term thinking the most are the ones least able to do it. When you're stuck under $5,000 in savings, your brain treats every financial decision like a crisis. Should I fill up the tank or wait until Friday? Should I get the brakes checked now or risk another month? These tiny decisions drain you. They eat up mental energy that could go toward building something bigger. And the worst part is, you don't even realize it's happening. You just feel tired, stuck, and frustrated without understanding why. This is where $20,000 becomes a turning point. It's not a magic number because of what it buys. It's magic because of what it removes. It removes the fear. When you've got $20,000 sitting in a high-interest savings account, you've suddenly got a buffer between you and disaster. The best Canadian HISAs right now are offering rates between 3.50 and 4.25%. And if that money is inside a TFSA, every dollar of interest you earn is completely tax-free. Your fridge dies, you handle it. Your car needs a transmission repair, it's covered. You lose your job, which is a real concern, with unemployment sitting at 6.7% according to the latest Statistics Canada data, and you've got around 4 to 6 months of essential expenses in reserve to figure things out without panic. That breathing room is everything. And here's what most people underestimate. That clarity doesn't just feel nice, it has real measurable consequences. When you're not stressed about money, you sleep better. When you sleep better, you perform better at work. When you perform better at work, you earn more. When you earn more, you save more. It creates a positive feedback loop that touches every part of your life. Your relationships improve because you're not fighting about bills. Your health improves because you're not skipping the dentist or putting off that physio appointment to save $100. The ripple effects go even further than that. You start thinking about the future instead of just surviving the present. You start noticing opportunities you were too stressed to see before. Of course, they could boost your income. A side project that could turn into something real, an investment that actually makes sense. When your brain isn't consumed by financial anxiety, it has room to think bigger, and that shift in thinking is worth more than the $20,000 itself. Now, here's where it gets really interesting. $20,000 is also the point where compound interest starts to become visible. Below that number, the returns are so small they're almost invisible. If you've got $2,000 in savings, earning 4%, that's only $80 a year. You barely notice it. But $20,000 at that same 4% rate gives you $800 a year in pure interest. And if it's sitting in your TFSA, the government doesn't touch a cent of it. Now your money is generating real, noticeable returns without you lifting a finger. It's doing more of the heavy lifting while you're putting in the exact same work. That's the shift most people never experience because they give up before they get there. But compound interest is only half the story. The other half is what happens inside you. Once you've saved $20,000, you've proven something to yourself. You've proven that you can delay gratification. You can say no to things that don't serve your goals. You can build something from nothing. You stop seeing yourself as someone who's bad with money. You start seeing yourself as someone who builds wealth. Think about it this way. When you've got nothing saved, every purchase decision is emotional. You buy things to feel better because your financial situation makes you feel terrible. But once you've got $20,000 in the bank, you stop buying things you don't need to impress people you don't care about. You stop leaking money on subscriptions you forgot about. The average Canadian household now spends $150 to $200 a month on subscriptions, from streaming to apps to gym memberships. You stop wasting cash on takeout meals you didn't really enjoy and impulse buys that gave you 5 minutes of dopamine and 5 days of regret. Your spending becomes intentional. And intentional spending is what separates people who build wealth from people who just earn money. Now, let's talk about what $20,000 actually unlocks in practical terms. First, it opens the door to real investing. With $20,000, you're no longer limited to a savings account. You can start putting money into Canadian index ETFs. The iShares Core S&P/TSX Capped Composite ETF, ticker XIC, is a go-to choice. It has delivered average annual returns of around 12.6% over the past decade, with a management expense ratio of just 0.06%, meaning you pay only 60 cents a year per $1,000 invested. You can hold it inside your TFSA, your RRSP, or the newer First Home Savings account, which lets you contribute up to $8,000 in 2026 tax-free if you're saving for your first home. Your money isn't just keeping up with inflation anymore, it's actually growing your wealth in a meaningful way. Second, it gives you negotiating power. When you're not desperate for money, you can negotiate harder on your salary. You can walk away from a job that underpays you. You can take a calculated risk on a side business or a career change without the terror of missing rent. Third, it breaks the cycle. This is the one nobody talks about. Most Canadians are stuck in the earn-spend loop. Money comes in, money goes out, nothing changes, and the cycle repeats every 2 weeks. $20,000 is the amount that finally breaks that loop. It creates a gap between earning and spending that grows wider over time. And there's a fourth thing that changes: the way other people treat you. I'm not talking about flashing money around. I'm talking about the confidence that shows up when you're not financially desperate. You negotiate differently. You carry yourself differently. Opportunities start appearing that weren't there before. Not because the world changed, but because you did. People sense stability. Employers, business partners, even banks when you're applying for a mortgage. Your financial position changes how the world responds to you, and $20,000 is the threshold where that shift begins. So, how do you actually get to $20,000 if you're not there yet? 3 things. First, get brutally honest about where your money goes. Track every dollar for 30 days. Most Canadians find at least $300 to $500 a month in spending they didn't realize they were doing. Audit your subscriptions and cancel anything you haven't used in the past 30 days. Second, automate your savings. Set up an automatic transfer on payday so the money moves into your TFSA or HISA before you can touch it. Pay yourself first. This is not optional. This is the foundation. Third, increase the gap. You can only cut expenses so far. At some point, you need to earn more. Ask for a raise, pick up a side hustle, sell things you don't use. Every extra dollar that goes into your savings accelerates the timeline. And here's something worth remembering. The hardest part of this entire journey is the stretch between $0 and $20,000. That's where it feels like nothing is working, like the progress is too slow, like the sacrifices aren't paying off. But they are. Every deposit, no matter how small, is compressing the timeline. The math works. You just have to stay in the game long enough to see it. If this hit home for you, subscribe to the channel and hit the notification bell. Thanks for watching, and I'll see you in the next one.